Let me now bring on board a very special guest, Prashant Khemka, co-CEO with Goldman Sachs Asset Management. Prashant, good morning. This is your first time on ET Now, so a very warm welcome. Good to have you on ET Now. Prashant, when we started the year...
Thank you, Nikunj. Thanks for having me here.
Prashant, when we started the year 2013, Indian markets were trading at the top of the heap. But that is not the story now. Indian markets are trading at the bottom of the heap. And suddenly we are not the good house in a bad neighborhood. What would you attribute this year's volatility to?
Certainly, see, the expectations were somewhat, charged up at the beginning of the year. We have had over the last 2 years, if you think of a pretty tough set of macro environment. 3 factors in particular, if you were to distill them down to, would be the high inflation, and which prompted a hawkish monetary policy, plus a global macro environment that has been in turbulence for most part, and also heightened policy uncertainty as we moved through the last 2 years. At the beginning of the year, these 3 factors, macro factors, were at their best possible over the last couple of years at least. And there's still, a couple of them are still at their best possible. So macro in terms of inflation has been coming down. It's still elevated, but it has abated from the double-digit levels, which has allowed greater room, flexibility to the RBI, and we've seen a couple of cuts already. Global turmoil, they no longer hog the limelight. At least, till a week ago, it had receded. And notwithstanding the most recent turbulence, it is still in far better shape than what we've generally seen over the last couple of years. And as is reflected from the low bond yields of peripheral European countries, as well as low levels of volatility indices around the world. The third point, which was also in somewhat of a troubled space over the last couple of years, which is policy uncertainty. And when I say policy, I'm including in it regulatory and legal, or polylegal uncertainty, if you will. That also had started improving from say July to September time frame, with a series of measures taken by the government. So all 3 combined together formulated an environment, a macro environment, that was much better than what we had seen over the last over the last couple of years. However, over the last 3 to 4 weeks, there has been a bit of a step back. If it's like 4 steps forward, 1 step back, and I count this as a 1 step back right now. We have seen that the investors, the market, were generally not very enthused, as their expectations from budget were very lofty, and some of those expectations were not met. And also the events of the past 7 days or so, both globally as well as in Indian politics, has somewhat soured the mood. And hence we've seen the market, which was a positive in January, has now pulled back in the negative space.
Prashant, we lost you there. You were making a point on valuations and how earnings have bottomed out.
Yeah, so earnings, if you look at last 5 years, as the economic growth went from nearly 10% to under 5%, there was weakness in several sectors of the economy, as well as pressure on corporate profitability. And that's the reason why, compared to a trend line growth rate of about 15%, earnings growth rate has only been a high single-digit pace. Now, as the economy bottoms out, which is where we are, I believe, and returns to a trend line growth trajectory, which generally over the last 20 years has been, and I have no reason to believe going forward it should be different over a longer time horizon, of about 7%. As the economy recovers from under 5% towards the trend line level, corporate earnings growth are going to accelerate because of an improving demand environment as well as improving profitability levels. And so from what we have seen of a single-digit growth rate, you could very well have a period of years which are in excess of mid-teens earnings growth. And while it sounds quite difficult to believe at this point in time, remember sitting in 2003, when we had prior 5 years of single-digit growth, we were then followed by growth of 20+% for next 5 years. And now to be clear, we are not suggesting or projecting a 20+% kind of earnings growth for the next 5 years, but to make money from here, to make decent returns from here over any reasonable time frame, you don't necessarily need to have 20+ return. I think reverting back to trendline growth of around mid-teens earnings growth over the coming years would be good enough to give reasonable returns. And that is what I'm saying markets should expect, investors should expect. We are not suggesting by being positive or constructive in the market, not suggesting that we are sitting at the beginning of a huge rally or we are dirt cheap, but it is a modestly attractive, reasonably attractive level to invest.
Prashant, I must admit though, your assumption of if I had money in my bank wasn't quite convincing. We take that point, but for the first half of this year, Prashant, then, what according to you would be a cap for the market? Well, you're not really convinced that this is going to be, the start of a great bull run and that we've bottomed out, but on the top, what's the cap that the market could be sitting at?
Certainly, see, the key risk, and which is what I think would put a lid to the market multiple. As I said, we are sitting at about 10 to 15% discount to longer term multiples. We have to get elections out of our way, which by most pundits' projection is going to be sometime over the next 12 months. I think until such time that the elections are in front of us, it's unreasonable to expect a significant multiple expansion. We should only expect the pace of earnings compounding, the trendline earnings compounding over the next 12 months, which I said is about 15%. For multiple expansion to take place, we need to see elections behind us, and then the market would have to take a view on the stability of the government, because that is tied with the sustenance of the policy environment. The initiatives that the government has taken over the last 6 months need to continue, need to sustain to improve the business and corporate environment, which would then reflect in improving or will support GDP growth rate, as well as would help in corporate earnings growth. So until such time that market formulates a firm view on the stability of the next government, it is unlikely that we would see a significant expansion in the multiple.
Prashant, you're focusing on the good part of the story. The bad part of the story is that Indian consumers are slowing down, margins are coming under pressure, we have a sub 5% print on the GDP, and investment cycle is broken down.
Sure, so let me be, if I was sounding too positive, I tried to qualify. I think I said that I'm not expecting multiple to expand, and the risk remains of, the political elections, a slew of elections, both domestic, both state level as well as central level, they are ahead of us. So I thought I adequately qualified those, but see, at the bottom of the, economic cycle, you are not going to hear and see a lot of trends that are super positive. So when GDP growth rate reported was at 4.5%, you cannot expect to see, big sections of the economy doing extremely well, because it is otherwise it would be disconnected with overall GDP growth rate of 4.5%. So I'm again not suggesting economic growth would be 7% in the year FY14, but I think if it bottoms out at where we are, about 4.5 to 5% over this quarter and the next quarter, and then shows sign of improvement, and maybe we average for the whole year of fiscal 14, not much higher than what we were in fiscal 13, say around 5.5–6%, that would be adequate for the market. It is the delta which is more important for the equity markets. We have been for the last 5 years more or less, slowing down with some, ups and downs, slowing down from sub 10%, nearly 10% to sub 5%. Forward, the delta of the GDP growth rate, which is more important for corporate earnings growth and hence the equity markets. If we were to bounce back at some point where consumer confidence is high, consumer spending is high, capital spending is high and all that, we would have and earnings growth north of 20%. So I'm not contemplating or projecting that. I'm projecting more of a normalized environment. In my view, we are below normalized environment. We have been below normalized environment for quite some while, and that's primarily driven because of this slowing economy over the last 5 years. In our view, the economy has slowed down enough to a level where it is going to bottom out, meaning it will stabilize here and gradually start turning back again. And so the delta, the second derivative of economy, is improving. And that's what's going to have impact on corporate earnings and equity markets.
Prashant,
so equity markets worldwide, you'll see rally well ahead of any signs of economic improvement. Just as in 2008, beginning of 2008, the equity markets collapsed well ahead of any visible sign of slowdown in the economy. In fact, the corporate earnings also slowed down, with a considerable lag. And similar would be the case, whenever the economic improvement takes root, the equity market would rally far ahead. Then you would see some signs of improvement in the economy.
Prashant, in the near term though, do you get a sense that the economy may be stagflating, stagnation in growth and consumption, and inflation still high?
Certainly, we've had for last 3 years, fairly high and rigid inflation and economic growth that is coming out. The question is whether it is structural or whether it is more transient in nature. In our view, it is more the latter. Inflation is certainly on a declining mode, even though not at a pace that we would like to see, because the pass-through of commodity prices is yet not complete. We are still seeing fuel price hikes, and that is flowing through the system. But from a 10+% level of inflation, we are already down to below 7%, and importantly, core inflation is below 4%. So that gives us a lot more comfort and confidence that barring a spike in commodity prices, which always remains a risk for Indian economy, barring such a spike, we should see inflation remain for the next few months in the 6.5 to 7% zone. And then as the effect of this pass-through of fuel prices wears out, it should start falling below that 6.5% level in the next year, providing further room for the RBI to cut interest rates beyond what's expected this year.
What has differentiated Goldman Sachs not locally but globally is out-of-box thinking. Goldman Sachs as a group, they always believe in taking big calls. So what are your current big calls? When you're making a case that the Indian economy is on a cusp of recovery, how are you positioning yourself to play that recovery?
Certainly, see, the way we invest, Nikunj, is very bottom-up. Our big calls are stock-specific. We never have, taken market timing calls. We do not have any confidence in our market timing ability, nor do we have any confidence in any of our competition's market timing ability for that matter. So we are not at any disadvantage. We focus on picking stocks that would do very well through the cycle, and on balance, the entire portfolio is in balance such that the entire portfolio should do well in different legs of the cycle as well. And so we don't see the need to reposition portfolio for every expected or projected turn in the economy. It is picking individual stocks all the time. Focus remains on that. Having said that, we've generally found the most attractive stock-specific opportunities in domestic-oriented sectors. By and large, I'm not saying that it's not supposed to be a blanket statement, because we do have considerable exposure in some of the global-oriented, particularly IT sector at this time. But by and large, fair to say we have substantially larger exposure in domestic-oriented sectors like financials and consumer discretionary, which in my view just so happens that at this point in time are also going to be disproportionate beneficiaries in a declining rate and improving growth environment. However, that's not necessarily the call. The call is far more stock-specific, the opportunities we see in individual stocks in those sectors.
Prashant, just to scratch that point a little forward, what else seems attractive to you? Because money only is pouring into either FMCG or IT.
Sure. So see, it is again constrained from what I can talk about individual stock specific ideas. But in automobiles, while the sector has been under pressure in terms of headline volumes, there are some gem of opportunities which are available there, particularly attractive valuations given the generally negative mood towards automobiles. Real estate is another such sector which has been out of favor for quite some while, particularly after 2007 bubble in real estate, but we have always found some extraordinary stock specific opportunities because the general market seems to paint the entire industry with a broad brush, that presents opportunities that can provide extraordinary returns over the cycle. The fundamental principle we believe in valuation is that if a company is generating free cash flows, and those cash flows do belong to shareholders ultimately and are given to shareholders, the market has no choice but to reflect that in the stock price. Sometimes it will be sooner, sometimes it will be later. So it is more stock specific and it is across every sector, Aisha. I just mentioned couple of sectors, financials, consumer discretionary and IT, but it's not necessary that our large stock ideas are limited or investments are limited to those sectors. Some of the largest ideas could also be from sectors outside of that, outside of those three.
But if I look at your last declared portfolio, one thing is evident that you are not a big fan of the entire PSU space. You don't own any big PSU banks, PSU metal companies, or for that matter PSU engineering stroke machinery companies. In general, are you averse to PSU stocks?
See, again, I would not generalize, and in any business, particularly in investing, never say never. But at this point in time, we certainly have greater exposure, particularly in banking, if you see, to private sector banks. But again, in PSUs, there are some gem of opportunities, and those we have good exposure in PSU space as well. Again, I would highlight that we tend never to broad brush any particular segment of the market, and in fact when market does so, when they broad brush a particular segment negatively, typically the best of opportunities are to be found there. Typically the multi-baggers over the next cycle would be found from that sector. Not to take away anything from the odds of multi-bagger ideas from consumer staples, and they could end up being as a pack also pretty good compounders of capital for investors over the coming years. But it would be more difficult for me to believe that you are going to find multi-bagger ideas now amongst the mid or large caps in consumer staples, because as you pointed out earlier, there is a high premium being paid for visibility. So, and this is a sector which I would say has been brushed broadly very positively. Similarly, there are other sectors, some of that you highlighted, which are brushed very negatively by the markets, and we look for the better opportunities. It's not that we are necessarily positive on the entire sector, which are viewed negatively by the marketplace, but within that we do find individual stock opportunities which can be outstanding, and regardless of what that sector does, can end up multiplying our investment for our clients over the years to come.
So Prashant, what about the slew of government paper waiting? You don't have to talk individual names, but you've got SAIL, Coal India again. None of it interests you?
See, again, I would refrain from talking about any specific, but suffice it to say that we have been, not why just PSU or government offerings, there have been slew of OFSs, to comply with many of the ownership requirements and all. And we have been selectively participating in those. These are legitimate investment opportunities to earn returns for our clients, and we evaluate every opportunity thoroughly. We meet with managements on the roadshows. We have our detailed models, our assessment of what the valuation is, and if we see a disconnect, a sizable enough disconnect between the value we deem and the price at which it's coming, we have been participating, but selectively. Fairly selectively, and will continue to do so, regardless of whether it's coming from government or from some private players.
Prashant, final question. I just want to extend your thesis that good news and good price, they never come together, and one such sector where news is bad and price is attractive is metals, global cyclicals. Are you a big fan of that space?
See, as of today, we are not. We continuously monitor, but we are not, because there are some fundamental risks, which obviously risks are across various sectors, but it is one of those sectors where just because, as I said earlier as well, just because people are negative and prices have fallen does not necessarily mean that they are great values. And in my view, in our view, metals is a sector where despite prices having fallen substantially, valuations are still not attractive. Fundamentally, there are several changes that have taken place over the last 2 years, 3 years, that have far-reaching effect on what are the sustainable returns on capital for commodity companies in India, particularly in India, also globally, but those global factors are applicable to Indian companies as well as some India-specific factors are applicable to Indian companies. And that's why I think it's more of a permanent step down of valuation for many of these companies rather than a cyclical or a mispricing related step down of valuation for these companies.
Prashant, one final question from my end as well. Leave us with your Sensex year-end target.
See, again, Sensex year-end target, Aisha, it's like asking whether it would rain in Mumbai on July 22nd or the weekend of July 22nd. I have no idea. If you ask me, whether it would rain in the month of July, I can bet my house. But on any specific day, I have no idea. And similarly, I'm, not going to stick out my neck on something where I have no idea.
So
I would say generally our expectation is.
Let's avoid the Sensex. Why don't you give me a Nifty target then? It's like saying, tell me in the next match which starts on 22nd whether Dhoni is going to win the toss or Michael Clark is going to win the toss. I'm betting India will win the match.
I can analyze the pitch. Sorry?
I'm betting that India will win the match. I mean, I'm sure of that.
Certainly. And that I would bet on as well, particularly given the track record and performance over the last 3 years. But look, more seriously, at any point in time, our expectation for the forward 12 months, typically the base case return expectation from the market is about 15%. And the reason for that is that's the trend line, long-term trend line earnings expectation from Indian corporate sector. Now, I stress the point trend line. Any particular year, it can be low or more, but the return expectation still would be more pegged to the trend line earnings expectation, which is 15%. You can add or subtract to them an amount that you can reasonably expect for multiple expansion or contraction. As I said, we are about 10 to 15% below very long-term averages. One may, being optimistic, may make a case why some of the multiple discounts should also narrow over the 12 months. But more realistically, we are sitting in front of a very important political event, the central election, which is extremely important, as all of us would agree. And in light of all the uncertainties surrounding that, it is unreasonable to expect multiple to expand from here, unless you have globally an environment where multiples globally are expanding and India gets pulled up along with that, because Indian valuations are tied to global levels as well. But all those you have to assume as all else equal kind of. So you have to assume global multiples stay where they are, global commodity prices stay where they are or where the current market is expecting them to be. And under that scenario, it is only reasonable in my mind to expect that the Indian multiple would stay where it is, plus or minus a few percentage points, and hence the return expectation would be 15% over the next 12 months. Compounded 15% over the next 12 years, but 15% over the next year.